Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be discussing employee stock purchase plans. So if you have an employee stock purchase plan available through your company, and if it's something that maybe you haven't paid a lot of attention to, hopefully some of the information that I'm going to provide to you in this video will get you to take a second look. If you're already participating in an employee stock purchase plan, I think this video should help you to understand some of the rules and understand, maybe just how some of those benefits actually work. So an employee stock purchase plan can be a great addition to maybe some of the other things that you're already doing in terms of saving money for your retirement or accumulating wealth. Basically, with an employee stock purchase plan, your company gives you the opportunity to buy their company stock, oftentimes at a discounted rate. So this could be another one of those so-called free sources of money, just like your 401k match is. So again, what we're going to dive into here are some of the rules and things of how they work, how much can you contribute, what are some of the benefits of the employee stock purchase plan, and how are the mechanics of the purchases and sales, how do they work in terms of the tax implications of employee stock purchase plans. So let's dive right in. Okay, so let's dive in and learn a little bit more about the details here. And by the way, what we're talking about in this video are what are called qualified employee stock purchase plans. That's under Section 423 of the Internal Revenue Code. Something called non-qualified employee stock purchase plans. That's a whole other topic. We may discuss that in a future video. But all the tax benefits and some of the features we're going to discuss here today are applying just to those qualified employee stock purchase programs. Okay, so let's talk about a couple of things. So first of all, there's going to be some common features of these. Number one is that you're going to have an open enrollment period. And so that's going to be something similar to maybe what you experience with your healthcare plans when you're electing different options for healthcare, maybe your life insurance that you might have through your company, your 401k elections. So one of those might be during that open enrollment period, you have the opportunity to sign up for the employee stock purchase program. And you're going to want to understand how that program works. And all these plans are going to be a little bit different, but what those generally are going to do is give you the opportunity to buy that company stock. Most often, it's probably going to be at a discount. According to the IRS, they give you up to a 15% discount, or your company can give you, I should say, up to a 15% discount in the company shares. You're also limited by the IRS to $25,000 per year, and that's going to be at the non-discounted price. So if you're getting a substantial discount, 10 or 15%, the $25,000 limitation is going to apply to the amount before that discount is taken into effect. So there are going to be some limitations to this. So as you're doing that open enrollment, you're going to decide how much of your paycheck or your income you're going to contribute to that up to those limits there. You also want to understand, what some of the other rules are. We're going to talk about some of the key dates and features of this, such as, when the stock is actually purchased, when the enrollment period starts. You also want to understand when you can change that. So if you go into this, when is the next opportunity if you wanted to either increase or decrease the amount of your contribution or stop it altogether. You want to make sure you understand that, and also understand when that opportunity may present itself to be able to sell the stock. And we're going to talk about what we call qualifying and non-qualifying dispositions of those shares, and understand what's going on with these different things within your plan. Okay, so now let's talk a little bit more about the taxes, and we're going to go through an example here in just a moment here, but let's talk about a couple of the key features. So number one, there is no taxes at the time of purchase, okay? So that's a benefit. There's also no withholding either, not even for Social Security or Medicare taxes, so no withholding as well. In addition, there's going to be a couple different types of income that we're going to get into as we go through our example here when you go to sell the stock. So some of that is going to be considered a bargain element, and you're going to be paying taxes at your ordinary income tax rate. That's going to be your highest marginal federal income tax rate. And some of it will be capital gains, either short-term or long-term, depending on how long you've kept the stock. And also, the amount of that bargain element is going to be determined by how long you've kept the stock since the original offering period, and also how long it's been since the stock was actually purchased. Okay, so those are things we're going to get into in just a little bit here. So let's go through kind of a couple of the key dates here. Okay, so number one, you're going to have your offering date, and that's going to be kind of the start of the period, okay? And it might be January 1st. If you started open enrollment maybe at the end of the year, and that purchase plan begins in the first part of the year, January 1st, let's say, they're going to start to withhold some money from your paycheck. And basically what happens is that money accumulates until the point in time when there's a purchase date. Okay, and every company is going to be different. This is going to be one of those things that you're going to want to understand before you go into this employee stock purchase plan. But understand, when are they going to purchase the stock? Sometimes it might be every quarter. Sometimes it might be twice a year. Sometimes it might even be just once a year. They might accumulate that money throughout the entire year. And then eventually you're going to sell the stock. So we're going to talk about what happens and what are some of those key dates and what's kind of going on. Now, one thing that may be available to you, and it's a really nice feature if your plan has that, it's what they call a look-back feature. And so what that means essentially is, let's say that the stock at the offering date was $25 a share, but at the purchase date it was $30 per share. What they will do is they will actually give you the price of the lower of the two of these. So if the price was lower on the offering date, your stock is going to be purchased at $25 a share. Let's say there was a 10% discount, so basically $2.50. So you're basically going to be buying that stock for $22.50. So made that a little sloppy there, but $2.50 was the amount of the discount. 10% off of $25 gives you $22.50 as your purchase price. If the stock actually went down, and maybe the stock over that quarter, that 6-month period went lower, and maybe the stock was only at $20, now that would be your purchase. And again, they would take maybe that 10% off, so minus $2 would mean that you would buy the stock at $18. So that's something you don't have to really worry about too much if they have that look back feature, because sometimes you might think that they're holding my money, and if the stock goes up, they're going to just be purchasing that stock at a higher price. So the look back feature, very important to understand that, and if your plan has it, I think it makes the plan all that much better. Okay, so now let's talk about what happens when you sell the stock, okay? And to do this, what we need to understand are two different types of dispositions. There's what we call a qualified disposition and a non-qualified disposition, and that's going to have a pretty big impact on how these gains or losses are treated for income tax purposes, okay? So let's first talk about a qualified disposition. And what that is basically, in order for it to be qualified, two criteria need to be met. Number one is it has to have been at least 2 years from that initial offering date, but it also needs to be at least 1 year from the purchase date. If it's a qualifying disposition, then your income taxes are going to break down like this. You're going to be paying ordinary income taxes. That's the amount of taxes at your highest federal marginal tax rate. You're going to pay ordinary income taxes on the amount of the bargain element at the time of the offering. In other words, what was the price of the stock at the original offering point, and what did you pay for the stock, that discount? And that's going to be, again, at your ordinary income tax rate. Then that becomes now your new tax basis or cost basis for the stock. And anything beyond that is going to be taxed at the capital gains tax rates, either long-term if it's been held for longer than 1 year, or short-term if it's been held for less than 1 year, essentially. And so, again, that qualifying disposition is going to give you a greater amount of what is more the preferential tax item, which is capital gains tax treatment, as opposed to the ordinary income tax rate. So qualifying disposition obviously is the preferred way to do this. We're going to get into now the disqualifying disposition. With a disqualifying disposition, you're likely going to have a much higher amount of that total sale hitting that ordinary income tax rate. Again, that's the less favorable tax rate, especially compared to long-term capital gains. And that's because the bargain element, or the amount that's subject to that ordinary income tax rate, is going to be the total difference between where that stock was valued at the time of the purchase, not the offering, but at the time of purchase, versus what you actually paid for the stock. So especially if that stock has gone up in value, that difference is likely to be a lot larger there. And when in turn, what that's going to do is it's going to raise your tax basis for the future sale. And again, if you hit that over 1 year and it hits that long-term capital gains tax rate, it'll be taxed at that more favorable rate, or if it's been less than a year, it'll hit the short-term side of things. but basically it'll have a much higher amount of that subject to the ordinary income tax. So what we're going to do now is we're going to look at an example, start putting some numbers to this, and I think some of this will start to make a lot more sense for you. Okay, so let's roll into our example here. Let's put our 3 key dates up there. So we have our offering date. That's when you very first start having that money deducted from your paycheck. And let's say at the time of the offering, the stock was at $25 per share. Okay. Then, obviously, like we've been talking about, that money is going to be accumulated for some period of time. Maybe it's for the quarter, 3 months, maybe it's 6 months or a year. And then you're going to have the price of the stock at the purchase date when that stock was purchased. And we're going to say that that was $30 a share at the time the stock was actually purchased. And then let's say that the stock goes up and you sell the stock for $35 a share. What we're going to do is we're going to look at this as an example and show both the qualifying and the disqualifying disposition and how the taxes work a little bit different there. Also, for purposes of the example, I'm going to assume that we have a look-back feature. So in other words, even though the stock was valued at $25 at the time of the offering but wasn't purchased until the stock was valued at $30, that look-back is going to mean that the stock was actually purchased at that $25. We're also going to assume, like we've been talking about there, that it's going to have a 10% discount as well, which means that using that look back, the stock was actually acquired for $22.50 per share. So if we then sell the stock for $35 a share, and let's first begin with the disqualifying disposition. Okay, so that means that you either didn't hold that stock for 2 full years from the time of that original offering, or you had the stock for less than 1 year after the stock was actually purchased, after that purchase date. So that's a disqualifying disposition. So again, what that's going to result in, as we're going to see, is a much higher amount of this transaction hitting your ordinary income tax rate. Because in this case, what they're going to do is they're going to use the full spread between that $30 per share at what the price was at the time it was actually purchased and subtract that full amount, that bargain element. So you're going to have $7.50 per share that's actually going to be taxed at your ordinary income tax rate. So you can actually have a disqualifying disposition, have this $7.50 hit your ordinary income tax rate, but if it's been a year since the purchase, you could still have some long-term capital gains in there. If it hasn't been a year, it's going to be at the short-term capital gains, which means that too will also be taxed at that ordinary income tax rate or your highest federal marginal tax rate here. But in this case, we now have a tax basis of $30 per share, and we have $5, which is going to be either long-term or short-term capital gains, depending on whether it's been a year since that actual purchase occurred. So again, $7.50 ordinary income tax. The rest is going to be at your long-term, short-term capital gains tax rate. Now let's see how this looks under a qualifying disposition. Again, what we're going to see here is a much higher percentage of this hitting that long-term capital gains tax treatment. And again, we know it's going to be long-term capital gains tax treatment because in order for it to be qualified, one of the rules of that is that it has to have been kept for at least 12 months after the purchase price. So it's going to automatically qualify for that long-term capital gains tax treatment. But here in this example, what we're going to pay taxes on at the ordinary income tax rate is going to be the bargain element at the time of the offering, which in this case right here is $2.50. It's the difference between the $25 share price at the time of the original offering and the 10% discount. So that's going to be at your ordinary income tax rate. It gives us a tax basis under this example of $25 per share. We sell the stock for $35, so there's a $10 long-term capital gains tax treatment. So it's going to have some pretty significant advantages over a disqualifying disposition. So the last thing I want to look at here and talk about is what if we don't make money on the sale of the stock? What if we sell the stock at a loss? Let's say that instead of selling the stock for $35 a share, we sell the stock for $20 per share. So again, going back to our qualified versus non-qualified disposition, the amount of our income tax that we're paying at the ordinary income tax rate is going to be determined exactly how we looked at it in the first couple of examples there. So under the disqualifying disposition, even though you're selling the stock at a loss, you're still going to have to add $7.50 per share on as ordinary income. Okay, and you've lost money. So what that's going to do is, again, it's going to give you that tax basis, just like we talked about before, of $30 per share. You paid $7.50 at your ordinary income tax rate, but now you have a $10 per share capital loss, long-term or short-term, depending on how long it's been since the actual purchase price. The qualifying disposition, you're going to still pay, even though you acquired the stock for $22.50 per share, you're going to have $2.50 hitting your ordinary income tax rate. And again, that's going to give you that tax basis of $25 per share. You sold it for $20, so that's going to give you a $5 per share. Again, we know it's long-term because it's qualifying, but a $5 per share long-term capital loss, essentially, is what that's going to give you. So that's it. That's a pretty good overview of how these employee stock purchase plans work. Again, be sure with your particular plan that you understand the rules, you understand the enrollment period, what your discount is, if there's a look-back period, when you can enroll, unenroll, all of those things. Make sure, as always, you read your own plan documents. But again, as I said at the beginning, I think these are one of my favorite types of retirement savings plans that you can put money away and accumulate. And I guess technically not necessarily always just for retirement, because you don't have the age 59 and a half rules like you do on a 401k or an IRA plan. You could accumulate stock, and at some point you could sell that stock down the road, hopefully as a qualifying disposition, as we learned here. But these could be great wealth accumulation vehicles. So anyway, I hope you enjoyed the video here today. As always, if you haven't already, be sure to subscribe to our YouTube channel. This video, by the way, is part of a series that I'm doing where I'm getting into some more advanced non-cash compensation features that you may have as employees, and that can help you to grow your wealth and take advantage of these different programs that your company may be offering. So look out for some future videos on that. And if you're interested about the financial planning that we do, you can head over to wealthvisionplan.com and learn about our Wealth Vision financial plan and see if that's something that might make sense. And if you like what you see on that page, there's a button there where you can schedule a free introductory call with me, and we can see if it's something that might be a good fit. So with that, have a great day, and I'll see you back soon in one of my next videos. Thanks.